Happy Friday. Brian Manning here with the weekly update. Let's get right to it. So, Monday, a lot of talk this week about the US dollar. We had Janet Yellen come out, said that people were shunning US based assets and the dollar's been at the lowest level in 3 years, and so much talk about the US dollar. So, what I'd like to look at is what is happening with the US dollar and what do we see in the marketplace for the dollar right now? So if we look at what Janet Yellen's talking about, this is the U.S. dollar. Yes, we look at it right now. It's at a very low level. I do understand that. But if we look at the U.S. dollar and we do a comparison, let's just say if we go back a little bit farther, we look at this. This is back to about COVID. Yes, we're still at this level of the U.S. dollar that's at a low. But if you look at this throughout in COVID, in 23 or so, we saw the same level. Into 24, we saw the same level. So is it off from its highs? The answer is yes, it is off from its highs. Is that at an all-time level? Well, no, let's look at this. So if we go all the way back to 2015, look at the level of the US dollar where it's been at before. So is it off where it has been previously throughout the year? Absolutely. It's at a low right now. If we look at this, but if we look at where the strength of the dollar has been all the way back for the last 10 years, clearly you can see this. So the challenge we have is we got Janet Yellen going out talking about the dollar, and the dollar is weak, and I understand that, and the media picks it up, and people start to freak out. And again, circling back to, we just got to watch what's going on with the media and pay attention to what they're talking about and kind of filter out the noise. Then Wednesday this week, we get retail sales. So retail sales for the month of March was up 1.4%. It was expected to be at 1.3%. So yes, it was higher than expected. But the core rate that strips out big ticket items was up 0.4%, and now is expected to be up 0.6%. So I think we got to watch retail sales. The question there is, was this a big bump up of sales leading into the tariffs? Are people buying more stuff out of fear that the costs are going to move higher? So some of these numbers that we're looking at for March, maybe we have to take with a grain of salt, and we'll have to pay attention to them as these numbers continue to come out for the months of April, May, and so on. Also, we had Jerome Powell speaking. So Jerome Powell clearly seems like he had a kind of dividing line here. What I mean by that is this: the Federal Reserve is supposed to have two mandates. So they're supposed to have price stability as a mandate, so that's controlling inflation, and then gainful employment in the U.S. marketplace. So they're supposed to watch unemployment as well. Well, Jerome Powell comes out. It certainly looks like he's favored inflation, and it definitely looks like he's taken sides on not wanting to do anything rate cut related because he's very focused on inflation. And I do understand we have to watch this, and we have to see what happens with the tariffs and see how this impacts the economy and if costs of goods are going to increase. But it definitely seems like he's taken side of the tariffs and not looking as much at employment and really starting to figure out, well, if unemployment continues to rise, what is the impact going to be there on the U.S. economy? Certainly his tone was not in any rush to cut interest rates, so we're going to have to wait and see what happens there. Now, I want to talk a little bit about bonds in the marketplace, because I have a couple people reach out to me and say, well, hey, what about all the selling of bonds? So the first thing I want to really bring up is, yes, we had a lot of volatility in the stock markets last week that was impacting bonds, and it caused rates to move higher. When there's a big sell-off in the bond market, mortgage rates react and mortgage rates will move higher. A couple of things to really point out and for us to pay attention to there. So first of all, when you have a big decline in the stock market, you have a lot of people that are leveraged, and it really pushes what's called a margin call. So if you're borrowing money in your brokerage account to buy stocks and there's a margin call that gets pushed through, that means you have to pay back the loan that you've been using to purchase stocks. Well, if the stock market goes down and you receive a margin call, that means you have a very short amount of time to pay back this loan. It doesn't matter if the market goes down and you receive a margin call and then the market moves up higher. It doesn't matter that potentially the stock market had recovered. As soon as that margin call is pushed through to you, no matter what happens, and if stocks recover, you have to pay it. So stocks went down last week. You had a tremendous amount of margin calls that took place. Typically, a lot of investors also have money in the bond market because that's usually a safe haven. So it's very common when a margin call is pushed through that an investor would sell bonds to get access to cash and liquidity that they would then use to pay back the margin loan that they had. So a lot of what happened last week and a lot of the impacts in the markets that we've seen for interest rates rising is really because of margin calls that went through. There's these things called basis trades. There's just a kind of a lot of feathers getting ruffled last week as far as the bond market is concerned. But if we look at this, And we look at China because the question I've received is a lot as well, is China selling bonds and are they impacting our interest rates? And for what we can see right now, the answer is no. The first thing is that over the years, China has been accused of manipulating their currency. And they have said for so long that they're not manipulating their currency, but they've been trying to keep their currency low for a very long time. And they do that because if their currency was moved higher, it would become expensive. So what do I mean by that? So when China's primarily an exporter, so when they sell goods to the US, they get US dollars, then they have to go exchange those US dollars for yuan. And if they keep their currency low intentionally, the exchange rate ends up better for them on the exchange side. Think about it this way. You went to Europe, you come back from Europe, you go grocery shopping, you have a pocket full of euros, you want to buy groceries. Well, you can't use those euros in the grocery store. You have to go exchange those euros for US dollars that you can use. So China, same way, big exporter, they're getting money pushed back to them. When they're getting US dollars pushed back to them, they have to exchange it from US dollars to yuan. So they've really been focused on keeping their currency low. So one thing we're seeing is they have not allowed their currency to get very high. Then you have the rumors of are they selling bonds? So a couple of things to look at. So first of all, the Federal Reserve holds $4.7 trillion of bonds. So the Federal Reserve is the largest holder of bonds. Then next in line, we have Japan. So Japan's at $1.1 trillion of securities that are held, specifically bonds. So they're the second largest holder. Then we got China in there. So China is at 760 billion or 0.76 trillion. So China is a very large holder of bonds, but if they did go and they sold these bonds at a mass level, then they would be strengthening their currency. And if they strengthen their currency, as I already explained, that would really be a challenge. So we could see here what the currency has looked like. Because of the currency not strengthening, that's really showing us that there's a lack of bonds that they're selling. Now, if we look at the bond market as well, the United States is the largest provider of securities like this as far as bonds are concerned. Then you have China and just the rest of the world. So the other problem is if China goes through and they sell a large amount of bonds, and then they want to reinvest that money someplace else so they're getting a better rate of return on cash, they really can't because there aren't many other banking systems, or really there's no other banking system in the world that could absorb a very large cash infusion from China to purchase a lot of bonds. So they're really limited there, and the United States is probably the one place, not probably, the United States is the one place where they can really invest that kind of money. So the other thing to just think about is that bonds have a lifetime attached to them, and over time, bonds, as they mature, they roll off. So you're also just kind of seeing right now the balance sheet and the securities that China has just really rolling off as well. So for everything that we can see right now, we have not seen really a large amount of bond selling from China. It would be kind of financial sabotage if they do that. Could they do it in spite of us? Of course they could. I'm not saying it's not something that they could not do, but we're not seeing it take place. A couple other things. One, we got a webinar coming up. If you're a realtor and you want to learn about condos because you keep having deals that are imploding and you just need to learn about the condo market, whether you're on the buyer side or the listing side, we got a webinar coming up. Click the link in this email. You should register for it. Second of all, third annual Boulder Party coming up. It's on Memorial Day, May 26th. It's kind of an open house party at my house. There is no need to RSVP. We are right on the course. It's super fun. We have a brass band that's playing again this year. I'm just ecstatic to throw this party again. So if you can make it to Boulder, info is in this email as well. We'd love to see you there. Happy Friday. Hope you have a great day.